And then let's look at the land market. I mentioned land, highly representative of future optimism or pessimism on behalf of developers. Well, the land market is also, you have to disaggregate it into its component parts to see how it's performing. If you look at the rental land market, the land to build rental housing, it's completely evaporated because we don't have a 421A or an Affordable New York program. We believe that we will have a new tax abatement program early in the next session. It sounds like it could happen as early as March or April, which would be great. Again, another reason why rents are so high in New York, because we are not creating supply. But we need that tax abatement program. But in the absence of the tax abatement program, rental land doesn't have a lot of value. Yeah, you could build a 100% affordable project, but what can you pay for land? 50, 60 bucks a foot? So if you look at that sector, we need the tax abatement program. When sellers come to us and they have a huge parcel of development land out in the outer boroughs and the highest and best use would be residential rental, we say, don't even think about selling it. Not worth it. We'll get back to you. We got to wait for a tax abatement to come back. That market, a huge air bubble in the pipeline there. If we look at condo land is trading, but in the past 14 months, that land is been negatively impacted to the tune of 25 to 30% because construction lending has gotten so expensive. So you used to be able to get construction loans in the sixes, right? Today, if you're getting a very conservative construction loan, 40 or 50% LTC, maybe it's 500 over SOFR, so you're in the mid-tens. If you want a 60, 65% construction loan, that's 650 to 700 over. So you're in the 11s or over 12%. That has exerted downward pressure on land pricing. And we're still selling condo land, but it's shocking the values that this land is going for. I think that is a great opportunity today to buy at such low prices based on what the way the market is performing today. If we look at hotel land, and this is a market that is in huge transition today. I am bullish on hotel land and believe that hotel land is going to make a comeback. For several years, nobody was buying hotel land for a couple of reasons. One, you could buy just about any hotel in Manhattan for less than land value. Two, now you have to get a special permit to build a new hotel, and that special permit will require that you build a union hotel. The economics are very, very challenging. And we have not had a single application for a special permit to build a new hotel here. However, the dynamics within the hotel market are changing so rapidly just over the past 2 or 3 months because there's been, again, a constriction of supply. We have about 120,000 hotel rooms in the city. 30,000 of them are no longer hotel rooms. 13,000 have been converted to other uses, student housing, what have you. And 17,000 are occupied by migrants. So we've taken 30,000 rooms out of the stock. And so what's happening? ADRs are going up, occupancies are going up, and you've seen there are about a dozen sites in Manhattan where they are grandfathered in. You don't have to get the special permit. And a couple of those are starting to trade. And I think we're going to start to see interest from the hotel sector, and I think hotel land is going to trade. And we need to see somebody break through that barrier and actually get a special permit and build a new hotel. I think that is going to happen within the next 12 months, but that's a very positive sign in that sector. And then in the office land market, it's really been a difficult market to get your arms around because there's been so few office trades for office land. And yes, it appears that within the office sector, new construction Class A office is doing relatively well. Everything else is facing its challenges. And I think that if you look at what we have in the city in terms of vacancy and the way the office sector is performing, our policymakers have to figure out a way to incentivize the conversion of a lot of this functionally obsolete office space to other uses. We just have too much. We have over 100 million feet that is or will be vacant. We went into the pandemic with 25 million feet vacant. It's 27.5 million feet under construction. There's 22 million feet planned. If aggregate demand goes down by just 10%, that's another 40 or 50 million feet. We have a lot of empty office space that needs to be dealt with. We have a desperate need for housing. I mean, how simple is this, right? I had lunch with the governor. I said, just do a 421G citywide. What happened? What did the 421G do to the financial district in Manhattan? Right, at 9/11, we had 1,800 dwelling units in the financial district. Today, there's almost 30,000. Why? Because of the 421G tax abatement program. Implement it citywide. Create incentives. I know Amin's here. Architects are figuring out great ways to get light into deep spaces. Right? There are ways to do this. And I think what's happening in the office sector, people are talking a lot about conversions, and I think there's a place for conversions in the market. But I think at the end of this cycle, what we're going to see is that the value of B and C office is getting to the point where, not quite there yet, but getting to the point where at the end of this cycle, we're going to look back and see that there were more office buildings demolished than converted to alternative uses, because the combination of the price of the building and demolition cost is lower than land value. And I believe that that's going to happen. And I think that if you look at the market very broadly, there is a huge demand for new in every sector. Look at how strong the condo market is on the Upper East Side west of 3rd Avenue. And more than half the buyers are buyers coming out of co-ops and buying condos because they want new product. Why is the office sector for new construction office doing so well? Because have you been in a new office building? Have you been in a newly constructed Class A office? You feel like you're in a completely different world than if you're in a 1980s building. And so I think there's such demand for new that I think if you look at pictures of the skyline of New York 20 years from now, 25 years from now, you're not going to recognize the city if we could look at that today, because I think there's going to be so much new construction going on here. So, but I think of all the sectors, office probably, especially that B and C office, that probably has the longest road to recovery. So where are we? Where is the market headed? What are we going to watch? Clearly, we have to look at what's happening with inflation, because the Fed is driving their whole policy based on trying to get inflation into that 2% comfort zone. We hope that they will start to moderate. There's no reason rates need to be as high as they are, and I can't believe I'm saying that, because over the past 50 years, the average 10-year Treasury is about 5.4%. So we're still below average, but there is not a reason for rates to be as high as they are. We hope that they do regulate. There is a lot of stress that needs to be taken out of the market, and a lot of that in the form of that refinancing risk, where what do folks do? The conversation we have most frequently with owners today is they still have a little bit of an equity cushion above their debt, and they need to refi, but they have to come up with $10 million to refi, or $15 million, or $25 million, and some say, Bob, I don't have the money. What do? I think we got to sell. Some say, you know what, I have the money, but am I going to put it into this thing? And these are the decisions that folks are going through, trying to figure out how to realign their portfolio, what decisions to make. And there's a lot of this that we have to go through, because there has really been a huge reset with regard to property values here. And when you see buildings trading at the same price per square foot they were trading for 20 years ago and 25 years ago, it is remarkable. But that is the reality that we're in today. So we're going to keep an eye on all of these things. And I want to bring you up to date on two other things. One thing, and then I want to get to Bashar to talk about Quincy. And that is how technology is changing things. And again, I'm not a technologically savvy guy, but I realize that you have to adapt. You have to adapt to a changing marketplace. And one of the things that we've done to try to really understand what's happening in the market, and particularly with regard to land. Some of you may follow me on social media, some may not, but we've created something we call the Knakal Map Room, and that came out of an initiative that we did during the pandemic. And I'll take you back to March of 2020, March 12th. We're told to go home for a couple of weeks and this thing will pass us by and everything will be fine. And my doctor called me up on the 12th and said, "Hey, Bob, there's a rumor going around the city's going to be shut down." And he said, "They're going to shut the bridges and tunnels. Get out of town. Get up to your country house." So within an hour, I'm in the car with my wife and daughter heading up to Connecticut. And obviously we left in a rush. 3 weeks later, it was clear that we weren't going to be back to normal anytime soon. So I had to drive back into the city to get some stuff that I left. And I pull up the FDR Drive, and I'm on the Upper East Side, and it was really like a science fiction movie. The stores were all closed, no cars on the street, no people walking around. And for years, I've always wanted to go do a physical count of the buildings under construction, because that information is not readily available. When we're doing BOVs on development sites, we always want to look at what the pipeline is of competing properties that are going to come online and compete with the building that we're selling, or the land that we're selling. And the residential companies all publish reports about what's in the development pipeline for condos, but they're all very different. They all count different things. So I wanted to go out and do it, and I'm driving in the city. I'm like, the city's a ghost town. I said, you know what, this will be a perfect time to get out there. So I called up Hags. I said, Hags, get copies of the Sanborn map. We're going to go out. We're going to do a physical count of all the buildings under construction. So we took pieces of the Sanborn map out into the marketplace, drove to a point A, got out of the car, walked around for a while, got back in the car, went to another location, got out, walked around, and highlighted every building that was under construction in green, highlighted potential development sites that were built to less than 25% of their buildable footage in orange, looked at assemblage sites, highlighted them in yellow, went back after 220 hours in the field, pasted all these pieces of the map together. The map now resides in the map room. And we've done thousands of hours of research on all those. So we have an unbelievable pipeline down to the square inch for every product type. We've disaggregated land into 5 major buckets: residential rental, condo, hotel, office, and then a miscellaneous bucket. So we have the pipeline of everything under construction, everything that's in the pending or planning stage. And we've also done a comparable sales study. We're coming out soon with the land index, which is going to also disaggregate land values into those 5 buckets. And we have that data going all the way back to 1984. And what we're doing is we're applying an AI application to that, where we're going to look at fundamentals within each of the buckets, obviously comparing them to rental rates within each of those categories, rental rates, condo pricing, et cetera, but also comparing the fluctuation in land value to the S&P 500, interest rates, inflation, Dow Jones, price of gold, consumer sentiment, you name it. And this AI application, I'm really excited about it because I think it's going to produce some predictive stuff. So I'm really interested in how technology is going to change the world in that way. But then I'm also interested to see how technology is going to change the brokerage business. And so I gave a speech at Columbia about a little over 3 years ago. I meet this young guy, Bashar, and we became friends. And he called me one day and said, "Hey, Bob, I'm working on a software package and a collaborative deal flow management system." And I said, "Wow, that sounds pretty cool. What's that all about?" And he said, "Well, I've been on the principal side, and it's inefficient how I get deals in all different directions, in all different formats. It's tough to keep track of everything. And so I want to make life easier for investors. And I want to make things more transparent, more collaborative." And He said, in order for me to do this, I need to know what you do every day, from finding out a building is for sale to sitting at the closing table. I need to know everything that you're doing. And we sat down for months going through literally everything that we do. And the result is Quincy, which is a collaborative deal flow management software that I think is going to change the way we do things. I think it's going to make life a lot easier for our clients. It's going to make things more efficient for us. And with that as kind of the background, I'm happy to have Bashara come up and talk to you about Quincy.